Hi everyone. So I hope everyone's well and having a nice start to the week so far. So this is more about you guys and giving me some questions, and we've had a number through already. If you click on, there should be a speech or a question mark. If you click there, you'll be able to ask a number of questions, and feel free to start writing those as you go along. We've had a few come through already as people were waiting, and we've had some come through prior to the actual webinar. So as I say, I'll be answering a number of questions that have come through already now. And then if you guys want to start to sort of write some more questions, or you can alternatively raise your hand, please do so, and then we'll get round to you, no problem. So the first question that came through earlier in the week was, where's the best place to invest in the UK? Now, this is one that we get asked a lot, as you can imagine. A lot of people are always saying, well, where's best places to put their money? And the answer is, and it's probably not the answer people want to hear, is there is no best place to invest. Now, what I mean by that is the best place to invest is simply the case of where you get the best value property in comparison to what the market is going at. So for example, if you've got a market rate property at 500,000, but you're getting that property for 400,000, well, you've got a great deal. So that becomes the best place to buy. If you're going to buy a property at market value, and I have to answer this question on everything being equal. So let's say that you didn't get a discount at all and everything was market value, then the question becomes a little bit easier to answer. But as I say, the first part of the question would be, is the best place to buy is where you can get the most undervalued property. Now, aside from that, if we just had the market value across the board, then the best place has to be cities in the north, whether that be Manchester, Liverpool, Leeds, Birmingham, Sheffield, Nottingham. One that's actually come under the radar recently has been Ashford. Now, this is not an exhaustive list, but it's the main cities which are making great gains for clients, both from an income perspective and a growth perspective. Now, Zoopla, actually, they do a monthly report, and the top 10 changes very, very slightly, but the top 10 in terms of growth over the last 12 months have been Liverpool, Manchester, Sheffield, Nottingham, Belfast, Leeds, Leicester, Birmingham, Bournemouth and Cardiff. So what we would say is, and that's in that order as well, by the way, guys. So what I would say is, in terms of the best place to invest, you've got to head north. I would always look at city centres or close to them as possible, good transport links, and you can't go too far wrong with, as I say, the Liverpools, Leeds, Sheffield, Manchesters of this world. That's the areas where you want to be looking at. So that's the first question. In regards to the second question that came through, that was, is there any additional costs when buying as an overseas investor? So yeah, there are. We have a lot of overseas investors that have come to us over the years, and typically they were all treated the same. Whether you were a UK investor or an overseas investor, the UK, in terms of the tax side and in terms of stamp duty, everyone was treated the same. However, that's changed recently. There's one difference, and that is that you pay an extra 2% surcharge on your property. Now, that's stamp duty. So everyone will pay stamp duty on their property, whether you be a UK citizen or an overseas citizen, but you will pay an extra 1%, an extra 2%, sorry, if you're an overseas citizen. Everything else is exactly the same. So you can buy in your personal name, you can buy in a limited company name, you have the same tax advantages as a UK citizen, meaning that you can fill in what's called an NRL1 form. So when you're letting, you will fill in an NRL1 form, which is a non-resident landlord 1 form. And that means that rather than being taxed at source, you will actually be able to file your own tax returns every single year. So what we do is, when we let for clients, we get them to fill in an NRL1 form. We then send the full funds out to the client, and then you can do your tax return yearly. So there's no disadvantage, as I say, for being an overseas buyer. It's only that extra 2% of stamp duty that you have to pay. Next question came from Steve, and Steve said, look, he was looking to buy locally. He feels that because he knows his local area, he prefers to buy locally than outside. Is this the right thing to do? Look, we always say to people, you have to first and foremost, do what's comfortable for you. If it's uncomfortable for you to buy anywhere else, buy your local area, then do what's comfortable for you. There's nothing worse than making a decision and making an investment, and it's a big investment. We're not talking about, you know, £2,000, £3,000, £4,000 here. You're talking about 50s, 100s, £200,000 plus. So you've got to be doing something that's comfortable for you. So what we say to people is, if you cannot get your head around buying outside your area, then of course you buy locally. But what we would say is, typically, just because you know the area, you know the prices, and you know the rentals, and it's on your doorstep, it doesn't mean that it makes financial sense. When you make an investment, it has to make financial sense. So what we say to people is, most areas that are local to them, they will make 2-3% at best. And that's gross, that's not even net, that's not even after your costs, so 2-3% at best. Whereas when you're living in, when you've got areas outside of that, for example, like the Manchesters, Liverpool, Leeds, etc., that are making 5-6% gross on a traditional let, or even 10-11% on a short-term let, you could be making 3-4% extra per year than what you would be getting in your local area. Now, 3 or 4%, you might say, well, okay, 3 or 4%, that's not too much, but do that over 10 years, and that's 40%. Now, if you've invested 200,000, that's 40% on a £200,000 investment. Over a decade, that's an extra £80,000. Now, again, that's another property just there. That's another deposit for another property straight away. So we would always say that typically, unless you're living in a buy-to-let hotspot, you're pretty much best to buy outside of your area. It does need a little more work. You do have to do a little bit more work in terms of trying to educate yourself about that area. Use a broker such as ourselves in terms of to help you educate yourself. But that work pays off. It's actually a fact that people spend more time researching where they're going to go on holiday in the year than they do for an investment. And your investment is all about your investment future. But people spend more time researching their holiday, which is absurd, but that's the reality of it. So what we say is, with a little bit of research from your side, you can make great gains going forward. The next one was in terms of current news. There's a lot in the media currently about things like COVID and previous news like Brexit. How much of an impact do these have on the property price? Well, typically is news, short-term news anyway, doesn't have too much of an impact. It does have an impact on things like stocks and shares. They're a lot more vulnerable to minor pieces of news. For example, let's say that a new variant of COVID gets announced. Suddenly the stock market might become a little bit jittery. But at the same token, suddenly the moment that people started to realise that there'd been a vaccine discovery, stock market rocketed. So you can make greater gains in the stock market over a short term, but you can also make greater losses in the stock market over a short term. When it comes to property, we always say that there are three fundamentals. You've got the legislation, taxation, and you've also got interest rates. So you've got interest rates when it comes to sort of like your mortgage lending. If interest rates are high or they start to jump, people have less chance of getting money because they can't afford the repayments. Taxation, things like stamp duty. So we saw when stamp duty gets reduced, property prices increase. And of course, legislation. So let's say the government decided to say that no one can buy a buy-to-let anymore, you're only allowed a maximum of 2 homes. That would be a piece of legislation that would change the property market. But it's only those things that really affect the property market. And we haven't really seen that. The last time we saw something like that was 2008, where we saw sort of interest rate changes, lack of liquidity coming out of the banks. And that affected it in a negative way. Where we've recently seen it in a positive manner is stamp duty being reduced, and of course 95% mortgages being actively given, which has meant property prices increase. So day-to-day news I never really worry about too much. For me, it's always the fundamentals that are far more key. Next question was benefits of off-plan versus ReadyNow. Yeah, really good question. We sell both. And the majority are fantastic. They both do equally good jobs. Some people don't have the money to buy something outright now, or they don't have the ability to get a mortgage now. So what they simply do is that they buy off plan, and then they build up a bit of a pot, and then they can complete on that in 18 months to 2 years' time. So there's advantages to do off plan there. also the fact with off-plan, you get things typically at a slight discount. You get 10-year guarantees on the structure of the property. You get 1 to 2 year guarantees on the white goods. Tenants also tend to prefer new builds with new technology, of course, and you typically will have a higher occupancy rate for longer. So that's a couple of things there. But of course, the downside of off-plan is you don't get your income straight away. And of course, there are other things. Sometimes you have delays on your project. Sometimes the project doesn't get complete at all. So you can lose that money that you initially go to exchange with. So that has to be taken into consideration. But overall, I would say the average off-plan development versus the average ReadyNow development, off-plan typically will win, because over a period of 5 to 10 years, there will be less outlay in terms of costs for that property. But both equally have their advantages and their disadvantages. Next question was all to do with guaranteed income. Should I buy with guaranteed income? Depends what you're buying. There's two types here. You're either going to be buying a residential property or a student property. If you're buying a residential property, it's a big no-no. For us, the main reason why is because typically you won't be able to get a mortgage on that. You will really, really struggle getting a mortgage with any residential property that has got a guaranteed income. That's the first thing. Mortgage brokers simply turn around and say that they feel it's what's called an investor-led scheme, and they just simply don't like it. So what we would say to people is, for a residential property, don't buy guaranteed income properties. And typically, if it's such a good property, why do they need to put a guaranteed income on it at the start? You know, all of these bells and whistles detract from what the actual reality is. And the reality is you're probably not going to get 10% guaranteed for 10 years or whatever they're promising. However, when it comes to a student property, totally different kettle of fish. Student properties are cash purchases. That means that you're not going to have to worry about mortgages, so it doesn't matter. You typically do want a guaranteed income because there's a lot of promise in terms of 8% for 5 years, whatever it may be. So I would typically say for a student property, then definitely that's something that you want to be looking at with the guaranteed income side. So on a residential property, no. Student property, most definitely. In terms of a couple of clients, they've asked about short-term lets. So we've had a number of different questions, guys, in terms of short-term lets and the benefits and how they work. So I'll try and encapsulate that all in one. So in regards to short-term lets, we do short-term lets through our trademark company called Skylet, and we let all over the UK, London, Leeds, Liverpool, Manchester, and it was a huge success before COVID. We're now starting to see green shoots come back again. It died a death during COVID, don't get me wrong. No one wanted to let short term for obvious reasons. But it's now starting to come back. We're now starting to see some green shoots. In terms of where I would be buying for short-term lets, I would always still buy city centre. Why? Well, because coastal areas are seasonal. If you buy somewhere on the coast, which is typically a non-working city and more like a holiday destination, you're going to be looking at short-term lets which are phenomenal throughout the summer months. There are some places in Cornwall going for £5,000 to £10,000 a week. So if you've got a decent place in that area and you're making £5,000 to £10,000 a week, that's fantastic for the now. But then the rest of the year you might have no one in it. And the reality is, as people can start to go abroad again and people are starting to travel more overseas, you won't be able to get £5,000 to £10,000 a week in those kind of properties for long term. They will typically go back to £1,000 to £2,000 a week. So unless you can make all of your money during that 6-week block, I would say don't buy coastal areas or holiday areas. Get things that are short-term lets that are close to sort of like leisure, arenas, football grounds. And by football grounds, it has to be a decent team who are in the European Cup or the European League. It can't be a team who just plays sort of every Saturday. You're not going to get the same kind of clientele. So city centres, again, like Manchester has 2 major football teams, Liverpool, 2 major football teams. Again, places like that, short-term lets work extremely well. And in terms of the cost, because one big question that we get asked a lot is, well, aren't the costs, wear and tear and other costs, aren't they inflated? They're not actually. Wear and tear isn't inflated because the reality is like everyone knows who's on the webinar today, is when you go for a short-term let on a holiday, typically you go into your room, you put your suitcase down and you go out. So there's actually less wear and tear. When it comes to things like extra costs, well, there are extra costs, but the costs are only raised, for example, things like cleaning and laundry, they're only increased when actually you've got to let. So that means the more income you've got, the more cost you've got. It's a bit like a quality problem. So the reality is although there are more costs, the costs are only increased and inflated once you've got that revenue coming in. Let's switch to a few questions that are being asked on the chat here. So one that's come through is, what do you predict is happening to international investors able to obtain mortgages as the exchange rate fluctuates? For example, will the exchange rate affect risk, which in turn will require international investors to put down more than 25% of the selling price? It's a really good question. So we have seen that. We have seen with international investors, what it all comes down to is not that they think that you're going to be a risky client. They have to treat everyone the same. They believe that, and this is what's in the back of the mind of the lenders all the time, is what happens if you just walk away? Because that's the worst case scenario for a bank. They don't want you to walk away. So that's first of all, the main reason why they differentiate between a normal residential property where you can put down 10%, or a buy-to-let where you have to put down a minimum of 25%. The reason why they do that differential straight away is because they feel that what are you going to likely, if you can't afford to have two properties, what are you likely going to walk away from? Are you likely going to walk away from your residential home or your buy-to-let? Well, it's probably your buy-to-let. So to stop you doing that, what they do is they try and get more of your money in at the start to protect them. One, because you're less likely to walk away from a bigger deposit. And secondly, if you do walk away, well, that house price can dip 25%, the bank can sell, and they will still break even. So with an overseas client or an international investor, they're thinking the same thing. They think, well, what if this client suddenly walks away? They've got no ties to the UK. They've got no income potentially in the UK. They are in an easier position to walk away than a UK client, because if a UK client walks away from it, from their buy-to-let, they would have certain either CCJs after their name, or it will be on their record. If an overseas investor walks away from their buy-to-let, well, typically that won't be on their record overseas as a negative for their future borrowing. So what do? Well, they ask for more money. They ask for more money down. Now, it might be the case where we have some overseas clients who have a number of properties. That really does help. If you've got a track record here and you've got a proven track record and you've got a number of properties, you're less likely to walk away. So what they do is they do sometimes ask, especially now where lenders are really risk adverse, they do ask for more deposits. And we are seeing a lot more of that, where we're seeing a lot more overseas clients ask for, being asked, I should say, for 35% of the property price rather than the 25%. Going back to the exchange rate fluctuations, well, typically the reality is that shouldn't impact you too much on your ongoing purchase. It will impact you on your initial exchange amount, but once you've paid your initial exchange amount, the reality is you shouldn't actually have too much of a concern about exchange rate fluctuations, because you're going to be paying your mortgage out of the proceeds from your rentals. So if your rentals are coming in sterling, which they will be because you're in the UK, so they come in sterling, you're going to be paying from sterling to sterling to your bank. Then you've got a choice. If the exchange rate is in your favour, you can take the remaining balance out to wherever you are, the country of your choice, where you're domiciled. If the exchange rate isn't in your favour, then you can obviously keep it in a UK bank account and wait until that particular time comes when the exchange rate is in your favour, and then send it out there. I think this is a question that follows up from that. It's asked, so if there's a property that requires only £10,000 down, but this is less than the initial 25% of the property price, would international investors still have to put down at least 25%? Yes, you would. So, for example, let's say that there's a property and it says you only need 10% down to exchange, but when it comes to getting a mortgage, you will still have to put down a minimum of that 25%. You can't just get away with putting down just that 10% mark. Another question here is, I've got a property that I've had in London for 18 years. I'm making 19% on it. This is how I'm working it out. Bear with me, guys. I'm just looking at how they've worked it out. Is this correct? No, it's not. Right, so it's a good point, because a lot of people do this. Typically, we tend to find that there are a number of different types of investors. So when we first ask or first speak to clients, we always ask, what is your track history with investments, especially in buy-to-let? And the majority of people have never had a buy-to-let before, but some have. But typically, the people that have had a buy-to-let before are either what's called an accidental landlord. That means that you've owned a property, your wife's owned a property. When you met each other, you decided to move in with each other, and you just happened to let out that other property that you weren't living in. That's an accidental landlord. The other type of landlord that we come across is one where you bought 15, 20 years ago, in the case of yourself here, who asked the question. So the problem with that is you're basing it on the price that you paid. So you put here, now I don't know where the property is, but you put here, you paid in London £160,000. Now I don't know where that is in London. So I wonder if you could let me know where that is, where you purchased, sort of, 17, 18 years ago in London for 160. But I'm guessing that that's what you paid for it at the time. So if you're making 19% on the back of that property, then depending on, of course, what other costs you had with that. But let's say, for example, you're making £9,000 to £10,000 rent, roughly, give or take on that, because I don't know if you're working out gross or net. But let's do round figures. If you're making £10,000 on that property, you've got to work it out on what the property is worth now. So, for example, if that property is worth, let's say it's worth £400,000 now, then the reality is you're only making 2.5%, because it's not what that property is worth. You have to work out, if you sold that property today for 400,000 and reinvested it elsewhere, somewhere that's giving you 5 or 6%, well, you would actually be making £20,000. So you'd be making more if you sold it and reinvested it than you would if you left it to where you are. So when you're working out, if you have an older property and you're working out what you're making on that property, you're simply taking the gross rent and you're dividing it by the property price now, not what you paid for it, 15, 20 years ago. That doesn't work. It's got to be what you paid for it now. Otherwise, you could have people that bought their houses in, the 1970s saying that they're making 100% of their property price, which of course we know that that's not the case. So you get the gross rental now divided by the property price, what it is now. That's the way to work it out. Another question here. Let's take a look. Mortgages. I'm working. By the time when I work out what I'm making on my property with taking out the mortgage cost, it works out that I'm only making 3%. Okay, this is another good question. So typically there are two sides to the transaction. There is the purchase price. So you've got your purchase price of 200,000, for example, and then you've got your deposit, which is one side of the transaction. That's what you have in the bank. That's your deposit, £50,000. Then you have your borrowed money, which is £150,000. Now let's just take that original 50. If you invested that £50,000 into the stock market, and let's go 10%, let's keep it really simple, and made 10% on that, then you're going to make £5,000 a year. If you put it in your savings account and made, whatever, 1%, then you know exactly what you're making per year. But the reality is when you invest in property, although that you're borrowing the extra money, you're borrowing that £150,000. That's essentially free money. If you're borrowing that £150,000 at 3%, but you're making 5%, well, you're making net 2% on that £150,000, which was never yours in the first place. You can't leverage on stocks and shares unless you're doing an instrument like CFDs, which the majority of amateur investors won't. So you can't leverage on stocks and shares. You can't say, well, I've got £50,000, can I borrow another 150? You can't leverage on your savings. You can't go to the bank and say, well, I've got 50,000 in my savings. Can you give me another 150? But you can leverage on your property. So the way you want to work it out is you've got this £50,000 on your property. And if that property is making you 5%, well, that's the same as what the stock market is doing. So if the stock market and the property market is doing the same thing, on that £50,000, you're making exactly the same. But the big advantage is if you've got that £150,000 extra that you've got from the bank that you're paying 3% on, but you're making 5% on it, you're making 2% net on that extra £150,000, which you wouldn't be making if you just left it in the bank or had it in the stock market. So with property, although your overall percentage, when taking into account the overall property price, it might seem lower, it might seem, for example, you're 3 or 3.5%, you're actually making a lot more than that on what is your invested amount. So sometimes when you work out your gross income on just your invested amount, it can actually be something like 15, 16%. So that's the numbers that you need to go on. It's another question that's just come through here. Let's have a look. Someone's sorry guys, it's a bit of a convoluted sentence. Oh right, okay. So once you've dealt, what are the next steps? Well, it depends on the company you deal with. But let's say that you deal with a traditional estate agent. Once you purchase your property, you then move that over to a letting agent, and that letting agent manages it. It's as straightforward as that. What we do is, once you've purchased this particular property through us, or reserved the property, you would deal with our back office team or a member of our back office team. They will run you through the next step. They will walk you through the process with the solicitors, and then you will be led right the way through to exchange and completion. If it's off plan, you will be given regular updates, and when it is completed, you will then complete. If you want to use us to let, we can do short or long-term lets. We can also furnish your property for you. We will take care of all of that. If you don't want to use us, you can use someone externally, no problem at all. But the idea is that we want to keep everything in-house. That's how we make more money, it's straightforward as that. And if we do a good job, then we hope that you're going to recommend us and so on. But we will do things every step of the way. We will ensure that we deal with everything from the lettings to the management. If something goes wrong in the property, we take care of it for you. And we deal with everything from start to finish, giving you a seamless process, and you get your monthly income. It should be as straightforward as that. There are obstacles. We don't get everything right. There are things that we have to overcome, but we make damn sure we work as hard as we can to overcome anything we can possibly do. Well, I hope that's helped, guys. There's been, as I say, quite a number of questions that come through today. So thanks for the questions, and thanks for those who sent some questions previously. Also, don't forget, guys, you can also contact me directly on the number below. You can contact any of the brokers as well. Feel free to get in touch anytime. And if there are any questions that you think of after this, feel free to let us know, and we'll go from there. Have a lovely rest of the week.